Assalamualaikum and a very good day to all viewers out there and all students. We are going to have another session on how to do this past exam question relating to consolidated statement of financial position. And now I'm taking the sample final exam question 1 for FAR320. And this is regarding hot and spicy that is having a year end of 31st of December 2020. Let's look at the information that you have here. You have the company here, hot and spicy. Hot is the one acquired the shares and debentures because this is a consolidated statement of financial position. The party that acquired shares is the holding company or the parent, and this is the subsidiary company. And this is the current financial year end. This is the date of acquisition, 1st of January 2019. The year end, 31st of December. So let's look at what we have as our requirement. If we look in the requirement section here, you have the company's financial statement that you need to prepare is as at 31st of December 2020. This is consolidated statement of financial position. So you need to prepare not just the statement of financial position, the consolidated, but also you need to prepare the schedule that will show the result of showing the result of goodwill and any bargain purchase. You need to show that. You also need to show the calculation of the detailed analysis of the calculation of good reserve and NCI. Then you need to prepare your consolidated statement of financial position. You do not need to prepare the journal as part of the compulsory answer, but that can help you understanding the question. Because you are asked to prepare the consolidated statement of financial position, your first step is to combine the items that are going to be included in the consolidated statement of financial position. So we will not be doing the additional information yet. We'll just focus on what to include or what to combine. So be looking at what to combine. I will highlight what will have to be combined. So the building will be combined because they are asset. Same goes for the motor vehicle. However, investment account here, that is investment in the subsidiary, this will not be included because this will be eliminated. The carrying amount will be eliminated against the goodwill and the non-controlling interest where necessary. We are also going to include the inventory, the trade receivable, bill receivable, and the bank balance. However, loan, which is an intra-company loan to spicy, this will not be included, and this will also be eliminated. It will be eliminated, and you will have to see what caused the elimination. If the information does not state, you will assume this will due to the cash in transit. You will include the one of holding share capital and the preference share capital, but what you would include is only of holding. You won't include the one of the subsidiary because the one of the subsidiary will have to be removed, right? So you will also include general reserve and retained profit, and you also need to have another new item to be included, non-controlling interest. However, this item that you include here should be the one that you work out from your schedule or whatever analysis of financial statement that you have done. Next is to also include long-term loans, long-term debentures, but make sure you eliminate for the debenture of the subsidiary. For example, you need to make sure that this one will remove the one acquired by the parent. Then you will include trade payable to be part of the combined item, bills payable and debenture interest payable. And you need to do some elimination if there is any intra-group debenture interest that has not been taken into consideration or that has to be removed. This one will not be included. However, you need to go and see what are the difference between the loan to and the loan from, and that difference will be due to cash in transit. So let's just do that first in our template that I have prepared. So the combined column here, or the combination column here, is to combine what? Combine the result of H plus S. H plus S means the result of the parent plus the subsidiary. So let's just do that. So what you will do is you will just combine without doing any adjustment yet. Just combine the one of the parent with the one of the subsidiary. So that is just a combination. You will have another column that I have created here for the adjustment, right? That will adjust for elimination of intercompany transaction or for any adjustment that will need to be removed or added to the consolidated statement of financial position. I create one row for goodwill because there will be a goodwill, or if it's a bargain purchase, you can just slash this, just include in the bargain purchase. Inventories, you will have to add all those assets that I've mentioned. But bear in mind, there will be some adjustment here. This is not the final figure. The cash in transit, as I've mentioned, there are no information, right? But as I was telling you earlier, this has to be also included because there are some intercompany loan balance. So if you can recall, the loan balance just now was 15 versus 13, where the difference was actually 2,000, and that 2,000 will be shown here as an intercompany transaction that you have cancelled off and that recognize cash in transit. So you have done that. For the share capital, for the ordinary share capital, what you would show is the one of the subsidiary, and the one of the subsidiary will not be included, sorry, the one of the parent only. So you will have 1.2 million. For the preference shares, you will not show the preference shares because for the preference shares, the one that is being acquired, is, if you can see here, there are some amount being acquired. For the amount that is not being acquired, amount being acquired is 150,000 out of the 200,000 preference shares, and 50,000 that was not acquired is the one that belongs to the non-controlling interest, and therefore the preference shares will not be included, right? So it will not be included in the preparation of the group financial statement. So what you would see here is that this will be included, but the preference shares will not be included. Why? Because it will be cancelled off to the non-controlling interest, the one of the subsidiary. However, should you have the preference shares of the parent, you will have to include that preference shares in the consolidated statement of financial position. So H only here is correct, only that here H has no amount. Holding company does not have any amount here. So therefore, for preference shares, you won't have any amount included for the consolidated statement of financial position, since there are no amount, since the one in the subsidiary will be eliminated. However, should the preference share is in the holding column, holding means hot, it is somewhere here, for example, there is an amount that should be shown in the consolidated statement of financial position. Okay. So we are not showing that because there is none that relates to the parent. For the group general reserve, we will be doing that later, right? So this will not be done here because it will be so messy to be doing it here. The loan, you will just first add the loan, but there will be some elimination later. For this part, there are no elimination because these are all related to the parent. For the part that is related to the subsidiary, you will have to do some elimination later. But for this section, it's done. It's nothing for you to go and adjust, right? And then for the current liabilities, you just need to add all those all the liabilities, and you will have to do some adjustment for the intercompany transaction. We'll be doing that later, and leave some space in case you have any ordinary dividend payable, preference dividend payable that need to be recorded. Just leave some space, right? Okay, you are done with the combination part. Now we can go back and do our adjustment. So if you look at the information given here, the investment in Spicy has 3 types of investment: ordinary shares, preference shares, and debenture. So if you look at the amount here, amount given here, this is the one that gives you the control. The one that gives you the control. Enough of this gives you the control, and you will have to find out what are the number of the shares. Since you have no information, you assume the number of share capital is also equal to 1 million unless stated otherwise. Then you are going to go and find out what are the amount for the acquisition of preference shares. You will have also to assume that the preference shares, the units are also 200,000. Since there is no information, you assume the fair value is also 1 ringgit here. The next one is you have your debenture. Your debenture 50,000, and take note that 8% debenture. So go to the 8% debenture. Out of this 100,000, you'll find out that that would be 50%. So those will give you some percentage of what belongs to the parent, and you can construct this table. Yeah, I'm showing it here to be your percentage of holding and percentage of NCI, as well as the percentage that relates to the other debenture holder or other preference shareholder in case that is redeemable preference shares. Okay, we'll go back to the question. So let's look at the first information. Okay, this first information, this is on the information that you obtain in the books of Spicy on the date of acquisition. Date of acquisition again is this. And these are actually the balances of the reserve. And this is your pre-acquisition reserve. This will have to be included in the fair value of net asset. However, you need to go and check before you go and finalize that figure. Check if there is any bonus issue that were taken from any of those reserves, and also check if there is any fair value adjustment on the date of acquisition that have affected the retained profit. For example, I'm referring to fair value adjustment that may relate to a deficit of the subsidiary. So go and check for that. Second adjustment. Second adjustment is on a fair value adjustment. So the fair value adjustment, it was revalued to 850,000 and 180,000. So this item is relating to a different types of assets. So I put a different color, 180 and then another one is 600. So the 600,000 is the one related to the land, and you have another one. Motor vehicle was 180, and the building was revalued to motor vehicle, sorry, was 180, but the building was revalued to 850,000, and all that was on the date of acquisition. All those figures that were given are all on the date of acquisition, right? Date of acquisition. And however, you are informed that the company, the group, has not made any adjustment to the books to show the new value. So when no adjustment was being made, so this is an adjustment that need to be made on the date of acquisition. So we need to do that adjustment. To do that adjustment, well, the first thing that you should do is to pick up what are the information given. So if you look the information on building was having a fair value of 850. So if you look here, the building has a remaining useful life for the building 16 years on 1st of January. So those items that I put pink in color is relating to the building. And there's another one that relates to the motor vehicle. Motor vehicle, yeah, it is a depreciable asset. It was depreciated on reducing balance method. For the item land, it is a non-depreciable asset, so there is no need for us to think of the effect on the depreciation. So if you have done that, let's look at the workings that I've done here. So these are the information on that fair value adjustment. If I can zoom it a little bit, right, so that you can have easy visual here. Okay, so the first column here that you have, this is the one for land. The one for land is that relates to the green item there. So just put the same color here, so easy for you to cross check. So I put green here as well. And the one for motor vehicle was actually what I used earlier, blue. So I use blue here as well to make sure that it's easy for you to cross refer. Okay, that's blue. So for the land carrying value on the 1st of January 2019, 600,000. That is also the same for the fair value. Why is that the case? Because the land is not being depreciated. It is a non-depreciable asset. So if you can check here, the item land that I'm referring to is this, and the building is this one, the carrying value, but this is not the carrying value on the date of acquisition. That is the carrying value as at the year end, the current year end. So what you need to do is, for land, no adjustment is needed because it will be the same. But for the building and for motor vehicle, you need to gross up this amount, right? Because the carrying value on 1st of January 2019 would be greater than the 750,000 and 180,000. How do you do that? You can use the information regarding depreciation for you to gross it up. And I've done it here. For the building, the fair value is 850 on 1st of January 2019, but the one as at 1st of January 2019 is not the one given in the question. The one given in the question, 750, right? But our building, okay, our building, let me just change the color. It's the other way around. Okay. Okay, for the building, the carrying value would be, so if you look at the information given in the question, you are informed that the remaining useful life on 1st of January 2020 was 16. So you need to find out what are the remaining useful life as at 31st of December 2020, so that you will be able to find the carrying value on 1st of January 2019. So how do you do that? You can do this. You can check here the RUL here, which is here, right, is 16, which is on 1st of January 2020, 31st of December 2019. So if it's here, it is 17, but the later it would be just 15 years. So by using that information, you will gross up by taking the carrying value as per the reporting date, which is 31st of December, 750,000, divided by 15 times 2. Times 2 because this is for 2 years that you are finding 2 years earlier. 1, 2. So that will give you 50,000, and you need to add back to that 750,000 to get the figure as at 1st of January 2019 for the carrying value. It is also 850. So if you compare the carrying value and the fair value, it is exactly the same. So here, no surplus, no deficit, no adjustment. And for this adjustment of surplus here, this is the one that you need to go and deduct. Yeah, you are going to reduce in the, you're going to go and adjust them by debiting the asset account. Here is the land, and you are going to credit the ARR, also land. And when you do this, this is done to the asset revaluation reserve on the date of acquisition. So you need to go and adjust your fair value of net asset later. For this one, no adjustment, so not applicable. And we go to the last item. The last item is on your deficit. So if you look at the deficit here, you have a deficit because the fair value was 180,000, and then you have your carrying value to find. Your carrying value to find is to take the carrying value on 31st of December 2020, which is 180, and gross it up again. To gross it up, use the information on depreciation. It was 10% reducing balance method. So how do you do that? You have to do it twice. 180,000 times 100 over 90, because 10% is the depreciation, right? So times another 100 over 90, since you want to know 2 years earlier. So you have 222 here, 222. So that will give you a, not a deficit, sorry, this is a surplus. That's a surplus. And the same thing, that surplus will be adjusted, of course, to your asset. And the asset that will be adjusted is motor vehicle of S. And you are going to credit the ARR of S. Oh, this is not a surplus, sorry, this is a deficit. So it will be debited to the retained profit. I'm sorry about that. Retained profit of S, and it will be credited to the motor vehicle of S. So this is correct to be a deficit. Okay, done. And there is a need for you to do some depreciation here. So you need to do depreciation from the date of acquisition to the current financial year end, and it would be 4222 for the first year, since you use the surplus, the deficit, which is times 10%. That is for the first year, and for the second year, from the date of acquisition to the current financial year end, it would be on the 4222. So it's a lot of numbers there. Minus this 4222. Here is 42222. Here is 4222. So take the 42222 minus 4222. So you have the amount 38,000. and that times 10%, they'll give you 3008, and here 8022 is your over provision. For the over provision, you will debit your motor vehicle S, and you will credit retained profit of the subsidiary with the amount. So that should be done in your schedule. So done with that, you will do the schedule later. We'll go back to that adjustment here. So here we are done. We are done with this. And we go to the second item. Our second item is on intercompany sale of inventory, where it was purchased from HOT. And it was purchased from HOT at a cost plus a markup, and the amount is still unpaid, and half of the amount is unpaid. Okay, so therefore what you would do is you would see that there are a few things that you need to do. Number one is to find out what are the unsold inventory, and you are informed it was unpaid as well. So the unsold inventory is half from the goods purchased from HOT. So HOT is the seller, so it is in the subsidiaries inventory, right? So inventory of the subsidiaries here, so you need to find out half of this. Half of this is half of 30,000, half. So that one will give you 15. So that 15,000 is the unsold inventory. And for that one, what you need to do is you need to go and debit accounts payable to remove the unpaid amount. That is an intercompany balances, and credit account receivable 15. So that will be adjusted in your Sofp, right? That was number one. Number two is to adjust for your unrealized profit. So who is the seller? The seller is HOT, the parent company. So debit retained profit of HOT and credit the inventory. So when you do this, your URP would be 15 times 20 over 120, because that is a markup, and that will give you an amount of, if you do it correctly, that should give you some amount that relates to the unrealized profit of the subsidiary of the parent, to be 2,500. So 2,005 here. So here will be 2.5. So go and adjust them in the schedule for the retained profit of the holding company. Next, we have item number 3 done. Number 4 now. Number 4 is on bills payable. For the bills payable, you need to go and find out what is the undiscounted bill. Our undiscounted bill is 75%. So 75% of 8,000 is 6,000. So the journal entry, adjusting entry, debit bills payable, credit bills receivable, because these are intercompany bills. How much will that be? That will be 6,000. Okay, that is done. That will be adjusted where? In the Sofp. Same goes for this. These are adjusted in the Sofp. Next one is the dividend. So for this situation that you have here, dividend of the company, Spicy decided to declare. So this is dividend by subsidiary. They decided to declare. So parent will have some share since parent acquired the preference share. So this is actually situation 2, where the case here is that both parent and subsidiaries company have not recorded for the dividends. So if that is the case, you have 2 journal entry. Number 1, debit retained profit of S. How much? You need to calculate the dividend. That is 10% from RM 200,000. That is 20. So it will be credited to the preference dividend payable. I write here PDPS 20. Okay. And since dividend that were declared by the subsidiary company belongs to the parent, you will also debit the preference dividend payable of S. Take the share of the parent, 20 times 75%, and that will give you 15. That will be income of the parent. So credit retained profit of the parent. This is income from subsidiary. But this must not be reported in the group account or group statement of financial position. Number 6. Number 6 is the situation that relates to the case where HOT has not taken credit. So meaning that HOT has not taken its share from the debenture interest of SPICY. So this is relating to situation 3. Situation 3, if you refer to the textbook, the explanation regarding the dividends and its accounting treatment, right? So here, what you would do is you are going to go and record on behalf of the parent the share of debenture interest. I'm doing this number 6 here. So you will debit debenture interest payable, credit credit retained profit of holding. By how much? Let us check what was the debenture interest declared by the subsidiary. It was 8,000. So out of this 8,000, 50% is the one of holding, and then another 50% belong to others. So we are going to take the one of the holding company, and that would be 8,000 times 50, right? 8,000 times 50, and therefore you will have 4,000 here, and that should be credited to the retained profit of the holding company, 4,000. Done. Number 7 is regarding bonus issue. For the bonus issue, you need to identify whether the bonus issue is it out of pre-acquisition profit or reserve, or which reserve is being utilized. You also need to identify who is the one that issue bonus share. So in our case here, our bonus share is issued by the subsidiary, SPICY. They declared the bonus issue, ordinary shares, 1 for every 100, using the balance available in the general reserve. So the general reserve will be reduced, but this is the pre-acquisition general reserve. Why? Since the balance in the general reserve is 40,000, we will use that because our bonus issue is only 1/100 times 1 million. So therefore that is 10. Our bonus issue is just 10,000, and we have more than enough to cover up the bonus issue, right? Using our general reserve. So done with that, this will be adjusted in the fair value of net asset calculation before you can arrive at the goodwill. Number 8 is just the information on how the non-controlling interest is being measured. Number 9 is on impairment. We'll be doing that later when we calculate our goodwill. We'll be doing that in our schedule. Okay, let's just do that in our schedule now. Okay, we go to the schedule. And we will be doing that schedule. So what you're going to do is you are going to prepare this schedule that you have here. So I would suggest you to have these 5 columns, 1, 2, 3, 4, 5, where the column here is non-controlling interest. This is group general reserve. This is group retained profit. This is the goodwill. This is the column for adjustment. And this is what you call the schedule to calculate group goodwill. So you will have the first few rows which is to calculate goodwill, and the remaining part, or you can split this schedule into 2 schedules. That's no problem. You can complete that and do a separate schedule 1, schedule 2. That is no problem. But this is done together. This is the schedule to calculate group reserve and non-controlling interests. Okay, this one, make sure that you have one column for whatever I've mentioned just now, these 5 items. And here, the first row that you should put under there is the retained profit of the subsidiary. Leave some few lines for the retained profit of the parent, and then the general reserve and of the subsidiary and general reserve of the parent, because our target is to find out this, but we need to do some adjustment that we have done. You can see that I put all the information that we have already adjusted here. We'll do that in our next video. I'll see you in my next video. I'll see you when I will see you.